So, good morning.
Good morning, James. How are you doing?
I'm very well, thank you. Thank you very much for doing this. We've talked to SDCL before, but I think this is the first time we've had you on the show.
Brilliant.
But as usual, I'm going to get you to talk a bit about the fund first and just tell us a bit what it's trying to achieve, please.
Brilliant. And a pleasure to do so. And thank you for inviting me, James. Yes, just over the next 20 minutes or so, I'm going to be introducing you to not just SEEIT, but also to the energy efficiency market and its importance in the energy transition. If we can go to, yes, slide 3. Thank you, James. Before sort of introduce you to SEEIT and what's in the portfolio, just wanted to go back to why SEEIT exists and what it's trying to solve for. And we have a big problem in the energy market. And the fact is that majority of energy, over 60% of the energy that is generated is lost by the time it reaches the end user. That's a huge, huge number. And it's not something that everyone's aware of. And that's a big problem in terms of costs. There's huge implications on that in terms of sustainability and carbon implication. And it's something that needs to be addressed as part of the transition to net zero and to have a more sustainable energy network globally. Where is it lost? Well, from the point it's extracted from the sea, for example, if you're talking about oil or if it's gas or even if it's a wind farm, from that point to the point at which you're switching your kettle on at home, there are a number of areas where this energy could be lost. The very common examples, ones that individuals can relate to, is just think about your building. There's a huge amount that's lost in buildings. Not everyone has LED lights. Poor insulation, a huge amount is lost in buildings. The other big area is just actually transporting the energy from what we call centralized, so somewhere that's not near where it's being used, to the end user. You do see significant losses. And the analogy I use in terms of sort of the whole energy network is that I use the analogy of using a bucket, is you can, to meet the needs of just the general population, corporates, everyone, you need to fill that bucket with energy generation. Now that's a combination. That could be wind, that could be nuclear, but you've got a big hole at the bottom of the bucket, and that needs to be closed. And that's what energy efficiency, the investments, the solutions it's trying to solve. It's trying to solve closing that hole so you don't have to build as much generation to get the same output. If we move on to the next slide. Before again going on to SEEIT, I wanted to talk about the main drivers for the market. So I've talked about the problem and what's driving the push for energy efficiency and essentially the market. Well, the case for energy efficiency has always been there. It's been something that has been in existence since even SDCL, the manager, has been looking at it since 2007. The fact is that there've been changes over the last 5 years in the sort of general market environment that's really brought this to the forefront of individuals, corporates, and governments. And we've listed some of these here. The first one is high energy cost and market volatility. This is something that everyone is sensitive to, where we've seen a few years of huge volatility, huge increase in prices, energy prices for everyone across the country, across globally, actually. And this is something that if you think about 10 years ago, people said, well, what's your energy bill for the month, for the year? It wasn't something that was a big priority. Everyone talks about it now. And that's just not individuals, that's corporates as well. So it's a big issue there. The second one is energy security. We're all now looking at, and particularly countries, governments, where are we generating our energy from? Where are we getting it from? We had the invasion in Ukraine last year. The US has always been focused on this, and there's everything going on in the Middle East means that the supply of energy is becoming more insecure. And looking at solutions where you can reduce the dependency from third parties for your energy is something that everyone's focused on. The third one is climate change. So again, sustainability, not a new point, but I've seen huge acceleration across the narrative for individuals, for corporates, for government. We just had a COP in December. That's been reiterated. And again, that's something that has become the forefront of everyone's mind. And it's been accelerating for the last few years. So all these three things combined is you get to the last column, which is you're starting to see a huge amount of policy support for energy infrastructure, and within that, energy efficiency. Examples of that for the viewers here, if they're not familiar, the US has implemented what we call the Inflation Reduction Act. Huge amounts of money being deployed across the whole energy sector in the US. We've not seen that type of investment anywhere before. And that is driving a huge amount of deployment and need for investment in the US. UK and Europe, not yet committed to the same level, but will be getting there. Still huge amounts in terms of commitment to the energy transition. We're seeing policies which particularly have energy efficiency as part of the solution being announced across Europe, as well as various measures being implemented in the UK. So, a result of this, you're seeing the need for energy efficiency solutions being required, not just by individuals in their houses, but also by corporates. The example I use is that if 10 years ago, if someone was looking at their energy costs, it would be a procurement director, energy procurement director, or if it's sustainability, it would be the sustainability team. That's no longer the case. They're still looking at it, but the conversation is also happening at board level. These points that I've just talked about are priorities for boards, for CEOs, for CFOs, and that is creating a huge amount of momentum in terms of needing energy efficiency solutions and energy solutions as a whole across the whole commercial and industrial sector as well. So we go into the next slide. Next slide, thank you. So I've talked about what energy efficiency is, and hopefully you got a feel for the momentum that you're seeing in the market sizing. Where does SEEIT fit into this? SEEIT, SDCL, Energy Efficiency Income Trust, was established in 2018. It's a FTSE 250 company and is the first and biggest London-listed investment company, which invests exclusively in energy efficiency assets and platforms. On this slide, we've talked about the key characteristics and strategies for SEEIT. So I'll start from the top, which is number one, which is, I've said it before in the previous slides, but energy efficiency and the solutions are essential to the net zero transition. We're aligned with being an Article 9 fund, and it's core to everything that we do in terms of what we invest in. And I'll come on to the portfolio construction in the next few slides. We are a total return focused fund, or SEEIT's a total return focus. We're very distinct. We're not a bond. We're not fixed income. Investors in SEEIT and the assets that SEEIT has invested in benefit from not just long-term contracted and visible cash flows, which supports a healthy dividend cover, but also from capital growth. This is driven by the nature of the investments that SEEIT has made that can take advantage of changing market conditions, but also through active asset management can deliver accretive NAV opportunities. A lot of these opportunities generated from what we call large organic pipeline. And by that, we mean that the investments themselves generate further investments. And because it's all organic and we're not going out competing against other investors, these investment opportunities are typically much higher in terms of returns, much higher than the original underwriting case. And it's something that we can control and build on our own within the SEEIT portfolio. The portfolio is geographically diverse. SEEIT has invests across Europe, UK, and the US. Currently, the portfolio has significant focus on the US. Nearly 60% of the investments are based in the US, where there are relatively attractive macroeconomic fundamentals there. We do have a significant portion in the EU, 20%, and 17% in the UK. The portfolio is net positively correlated with inflation. Over half the revenues are partly or wholly inflation linked, and therefore providing an overall positive correlation to inflation. And finally, SEEIT employs a low gearing strategy we don't rely on aggressive debt structures to achieve our returns. The returns are generated from the core fundamentals of the assets themselves. SEEIT, as at 2023 interim reporting date, had gearing at 44%, which is equivalent to around 31% of loan to value. And our medium-term target is around 35%, so relatively conservative compared to other companies or our peer subset. If we move on to the next slide, I wanted to talk about how SEEIT's portfolio has been constructed. So we talked about before the problem, a lot of energy is lost. This Venn diagram here talks about the three areas where you can reduce that energy wastage. I'll start at the top, which is cleaner, more efficient supply. A big area where energy is lost is in what we call transmission and distribution losses. So you're taking the energy generated from one part of the world and then it's being used somewhere else, either in the same country, but it has to travel a lot. So cleaner, more efficient supply, the purpose of that is bringing energy closer to the point of use. So you reduce what we call transmission and distribution losses. An example of this is our investment in Onyx, which is a developer of what we call on-site energy in the form of solar and storage. So in the terms of picturing this is rooftop solar, carport solar. So the energy being generated by the solar project is on top of or next to where the energy is being used. And Onyx has thousands of solar projects across the US, all on site. Another example of this is primary energy, which is recycling waste gases from blast furnaces, cleaning them up, recycling them, putting them through a turbine, and to provide heat and power to the same blast furnace. So everything is next to each other and on site. So that's cleaner, more efficient supply. That's one way in which you can reduce energy wastage. The second one is point of use demand reduction. And this is one that will be familiar to most people in their day-to-day lives. So this is reducing energy at the point of consuming. And examples of this is LED lighting in buildings. There's a huge number of buildings globally, and even in the UK, that still don't have LED lighting. And the payback for that and the energy reduction, you could recoup your investment in a couple of years. They're so effective. Insulation and other heating and cooling solutions. So that's point of use demand reduction. And the third one is green energy distribution. So this is connecting energy where it's generated to the end user in the most efficient way. Sometimes it's not possible for physical, logistical reasons to have the energy solution on site. So you find other ways of doing it. And a typical example of this would be district heating, so localized energy production. So when SEEIT has the portfolio, the way it's been constructed is the first thing is that the investments have to fall into one of these three Venn diagrams. Sometimes the solution, because there's multi-solutions, falls into two of those three. And then we have one of our largest investments, Red Rochester, that falls into all three. So energy efficiency typically is a combination of different solutions to help end users reduce their energy consumption. So that's the first layer. We move on to the second layer level of how is the portfolio put together. Whilst there's a number of different technologies, and we're really pleased that we have diversification in terms of technology, most, if not all, of SEEIT's investments have the same type of business model. And that's the commonality that you get across all the assets. And we provided a schematic that essentially, at a high level, describes how each asset works. So you have an asset, SEEIT owns the project. So this could be light bulbs. It could be a solar project. That project, and I'm going to stick with the solar project as an example, it's providing energy as a service. We're always providing something as a service, and there's always an end user. So compared to typical renewables, where you build a big solar project and it's connected to the grid, and that's then dispersed across the network, we're always providing to an identified end user, typically someone I can shake hands with. And we're going to provide that. That service can be anything from 5, 10, 20 years. and we're going to provide solar as a service to that building or to that end user. In return, that end user is going to pay me for that service. And and it's typically in the form of what we call a power purchase agreement or a service agreement. And this is why the revenues generated by each of these individual projects is highly visible. Because I know when I've installed a solar project, I'm contracting for at least the next, typically 20 years. And I've got visibility of what I'm charging. It's typically fixed price. It could either be inflation linked or index linked. And I can see for the next 20 years where my revenues are coming from. At the same time, so that's revenues. On the other side, there's commonality in terms of how the costs come out in the projects. Now, SEEIT doesn't take any unmitigated, what we call commodity risk. So gas pricing is passed on to the end customer, electricity costs, anything that has what we call a merchant exposure is typically passed through to the end user, or there is some mitigation such as hedging in place. The other cost that you typically have in a SEEIT project is fixed overheads. That's typically labor, where you're managing the assets, good visibility on that. And then there's a small level of what we call variable costs. Again, we have good visibility on that. So on one side, you have good visibility on the revenues. On the other side, you have good visibility on your costs. And as a result, this is what generates net cash flows from each project that is highly visible over the long term. And that is common across all of SEEIT's investments. So again, that's what we see across all the investments. There's a third aspect, which is on the next slide, which is going back to my point of total returns. The previous slide talked about how we generate long-term visible cash flows that supports the dividend cover, but there's a total return story. Typically, the majority of our investments have what we call an upside accretive opportunities. So this is where SDCL as the manager will work with the assets, work on the investments to generate returns in addition to what's currently in the NAV. So, and this can be done through various things such as recontracting contracts, improving the efficiency of the projects, unlocking new revenue streams. All of this is active asset management that SDCL does on behalf of SEEIT to generate additional returns. And that's hugely attractive because this is what brings the total return story to SEEIT. So just to recap, whilst there's a huge amount of diversification across technologies, geographies, and amongst other things, there is consistency and commonality across all of SEEIT's investments. Moving on to the next slide. This is just giving visualization to some of our largest investments in SEEIT. I've talked about primary energy, I've talked about Onyx. All of these investments provide efficiency solutions in the way I've described before. One thing to note in terms of SEEIT's portfolio, the largest 6 businesses in SEEIT's portfolio, which we've identified here, they comprise 3/4 of its value. And then the remaining tail of around 25% is held in smaller investments, which we are working on to grow. With the exception of Red Rochester, which I'll come on to, these businesses comprise of multiple standalone projects, and therefore you get further diversification. In Red Rochester, which is a district energy system, it has over 100 customers. So we're key to make sure that diversification exists across the portfolio, but also in individual investments as well. Moving on to the next slide. So again, this is just highlighting the points I've made before. We are pleased with the diversification across a number of metrics in SEEIT. I've talked about the investments. Technology, we have a good diversification from solar and storage, district energy, EV charging, lighting. 2 points I'd like to make out is the geographic diversification. So we are majority or predominantly exposed to the US, where we have seen favorable macroeconomic and policy tailwinds. And the other part is life cycle stage. The majority of SEEIT's investments are operational, cash flow generating to support the dividend. But again, in alignment with total returns, there is an allocation towards development and construction. And as those projects come into operations, opportunity for yield compression and upside opportunity. So moving on to the next slide, the financial results. So SEEIT has seen, I'll touch upon some of these numbers, but I would point towards our interim results, which were presented in December, which can be found on our website. But SEEIT's seen significant growth since 2018. The key driver performance is NAV per share, which is a function of the combination of the outlook for the business and the valuation the market puts on it. Now, along with a number of other investment companies in the sector, we have seen NAV fall over the previous period. And this has primarily been driven by increased discount rates due to higher interest rates, which increases the asset-specific risk premium applied, whether it's in the US or in the UK and Europe. Discount rates and market valuations for all London-listed income-orientated investment companies have been impacted by this rising rate environment. Dividends have grown over 20% since the first full reported year, and cover has remained consistent in the company's history, and cash flow continued to grow period by period. We're expecting the full year to show an increase on the mid-year position. And also we've talked about consolidated gearing, which has remained at a relatively low level compared to other investment companies in the market. Moving on to the next slide. 2 points I'd just like to highlight from SEEIT's portfolios. The first one, we've talked about inflation. We are positively correlated with inflation. And with exposure to the US and the market dynamics there. The one I'd like to point out is that we don't have material sensitivity to power prices. All the investments we've made in SEEIT have no unmitigated exposure to the merchant market. So in a volatile market where you're seeing ups and downs on energy pricing as well as gas pricing, that is something that SEEIT has no exposure to and has mitigated through various hedging. So that's why we don't show power price as a portfolio sensitivity. Moving on to the next slide. So I wanted to talk about why SEEIT is an attractive opportunity for new investors as well as existing ones in the current market. We are alive and sensitive to the share price discount. It's something that we focus on as a manager, as well as our board. Currently, the NAV per share the discount is much higher than it has been previously before the market malaise. The way the share price at the moment is offering an attractive discount as well as an attractive dividend yield as well. So it's a great opportunity to invest in SEEIT now, but we are actively working to close that discount. And we have a plan, which we've shown here, and also which we presented in our interim results, is what we're doing to reduce the discount. And it's a lot of focus in no particular order and in no priority. Number of strategies we're deploying. We are pursuing disposals. The purpose of this is, one, to demonstrate to the market that our NAV is robust. The other one is that with the proceeds, we would look to reduce gearing as well as potentially invest that capital into higher returning assets, given where the market is. We've updated our capital allocations policy and now focusing solely on organic pipeline with an appropriate level of returns that reflects the discount in the share price. We have taken feedback from all our investors across the board and making sure that we are addressing where they need what they need to see, both in terms of additional disclosures, breakdown of our NAV, and also making sure that we are focusing on delivering the performance of the assets. We are ensuring that we are focusing on those upside opportunities I've talked about, and making sure that the portfolio is delivering what we've said to the market. And finally, we are working actively on improving the marketability and liquidity of SEEIT shares. You will hear from SDCL. You'll also hear from our CEO, Jonathan Maxwell, who's the founder of SDCL, making sure that everyone is aware of the attractive opportunity that SEEIT brings. And so to conclude on the last slide, we think this is a great time to be buying SEEIT shares. There is a discount currently. We're working to close that, but whilst there's a big discount, this is an opportunity, but both in terms of total returns, as well as attractive yields. Outside of just the share price, there is a huge opportunity for SEEIT, given the market dynamics around energy efficiency. We are one of the few pure play energy efficiency investors in the market, and investing in SEEIT gives investors an access to underlying assets that are addressing this energy efficiency solution. We have exposure to the US, which has massive policy tailwinds and a huge opportunity in terms of returns and growth. And with the conservative gearing targets and the total return strategy, we think this is a brilliant time to be investing and for investors to gain not just the financial returns, but also to invest in a fund that is critical to the net zero transition. So I'll stop there, and James, happy to answer any questions you have.
Great, thank you very much indeed. So there's loads of questions actually, and trying to decide where to tackle them. There's a big picture question that we should probably go with first, I think, is that we did have 3 energy efficiency funds within the sector. The 2 small ones are looking like they're just going to disappear.
Yeah.
Why? And obviously your discount's gone very wide. Why do you think it is that investors don't seem to be embracing this kind of energy efficiency story?
Yeah, so I mean, I can't comment on the other 2, James, and it'd be inappropriate for me to do so, but I can talk about SEEIT. I think, as I mentioned before, energy efficiency has always been a solution to getting to as part of this energy transition, but it's not been at the forefront of people's minds for a long time. I've been at SDCL 8 years, and at the time you were seeing huge growth in solar, in wind, things that sometimes can even take a nice picture. But it wasn't something that was seen as a priority or a headline. And that's changed over the last few years, particularly with what I mentioned before around the market drivers and energy costs. It's been and this is not just with investors, this is with governments as well. And is it has still got the headline and the exposure that I think it should do? No, there's still more to happen. And you're starting to see more players, more investors in the market because they're seeing how critical this is. There's another aspect, which is the solutions to energy efficiency. There's not one single technology that you can point to say, this is how you solve the energy efficiency problem. There's multiple ones, and it takes a bit of time. And we're working on this in terms of communicating more to the market, how those solutions come about, how they come together, and simplifying the story a bit more. But there's definitely more work to be done. On the flip side, because people haven't seen or are still learning about this is why it's a good opportunity to get in now, rather than a few years' time or a few months' time, where people will be more savvy on what energy efficiency is, and you'll start to see a momentum on that front.
Okay, thank you. On the gearing side of things, I mean, I know you've gone great pains to emphasize your conservative gearing, but obviously we've gone through the target because the NAV's fallen. And you said you're going to try to address it through disposals and things. Couldn't you just live with a slightly higher gearing, seeing it's quite conservative?
Yes, it's in terms of gearing, it's something that we're alive to, and we purposely went ever since we've been set up. It's been part of SEEIT's strategy to remain conservative gearing. We have got a long-term gearing of 35%. There is an ability to go up to 65% on the short-term basis. So what we call it with acquisition financing, pretty much using the RCF. So that is something that we can do. And if it's in the best interests of the portfolio and our investments, for example, to support higher return investments for example, in Onyx, that is something we'd be alive to doing. But part of the story, what we've heard from investors is that at the moment, having short-term financing such as the RCF, better to be conservative in that approach, given where the market and interest rates are.
Okay.
But it does, but having conservative, targeting a conservative approach means that gives you flexibility should you need to use it as part of investing in the portfolio.
Okay, thank you. Now, obviously, the big problem last year was the rates going up.
Yeah.
And this is all struck at the end of September 23. We weren't far off the peak in US government borrowing costs then, which I suppose is the thing that probably most heavily influences where the discount rate is.
Yeah.
Can you see as we go through this year that those discount rates will come rattling back down again, or do you think that the NAVs are more or less right now?
So I wouldn't hazard to try and guess where inflation and interest rates are going, James, because there's a whole world of opinion. We would expect that if interest rates are peaking and as those go down, you will see a correlation to where our discount rates are. And not just ours, you'll see it across the board with other investment companies are. So that's what we would expect to see. But we're not just relying on that. What we're looking at is, I've talked about total returns, James, which is in addition to looking at where discount rates are, which helps improve NAVs. That's why we're spending a lot of time on what we call accretive opportunities, so that we can build on the NAV independent of where discount rates go.
Okay. So is it the higher borrowing costs that are pushing pressure on the cash cover for dividends? And do you know, have you said anything about where you think dividend cover is going to go in the long term?
So we've always talked about progressive dividends, and we do give markets signal our intentions on a look-forward basis. The dividend cover, the 1.1 is at September 23, so we expect that to sort of be in line with historics by the end year. Mid-year is always a difficult comparison to the end year. But like I said, we've always maintained that we would look to have a progressive dividend, and that's what we've certainly, as part of our interims, is what we've stated to the market again.
Okay, thank you. Now let's think about portfolio slightly more. There we go up. There we go. So I don't know if it's timely to look at anything in too much detail, but can you sort of pick out your sort of favourite thing in here and just tell us a little bit more about it, please?
Yeah, I mean, obviously I had no favourites because they're all great. But the one I'd talk to, because it's one which, well, there's two that I do point to, because they're ones that people can sort of visualize better. So the first one I talked about briefly in the presentation was Onyx. So Onyx is a developer. They develop, own, operate rooftop and on-site solar projects, so linked to the buildings themselves. This is across sectors such as municipalities, universities, schools, hospitals, and also high-quality credit commercial customers. And they're across the majority of states across the US. Now, we can look at Onyx in two ways that align with what I've talked about being total returns focused. When they build the projects, or when SEEIT invests in these projects and solar projects, builds them, you have a long-term PPA contract with the end customer. And let's use school as an example, or a hospital. They'll provide the solar energy or solar power to that hospital for the next 20 years. The hospital will pay for the next 20 years. And then we know the costs. You have operational maintenance costs of the projects, which are highly predictable. So what those projects are doing is generating long-term visible cash flows that SEEIT benefits from, and what drives the dividend cover for the fund. On the other side, Onyx itself is a company which is developing projects. It has a pipeline. It in itself has value, and the more it deploys, the more value it becomes, and that is additional return on top of the project. So that's what we call the total return. It's a company that has an enterprise value. And so this is where the deployment of capital into projects not just delivers the long-term cash flow, but then you get this additional value from creating a company, a solar company, over the long term. So that's Onyx. The other one is another US investment, which is called Primary Energy. I mentioned that. I think this is a very unique project or set of assets, which I've not been able to find anything of similar scale globally. So what you have in the US, you have blast furnaces. I know there's been something in the news here in the UK, but you have critical blast furnaces in the US that produce steel for infrastructure, for cars. One of those blast furnaces is the largest, most profitable blast furnace in the US. It produces a huge amount of waste gases, they're hot waste gases as well. So what do you do with those? Our SEEIT's asset, it's called Coke Energy. It takes those waste gases, and Coke Energy is sitting next to the blast furnace. It's taking those waste gases, it cleans them to ensure that there's no harmful emissions being exhausted out of the blast furnace. It then cleans it. It takes that hot waste gas, it puts it into a turbine to produce heat and power, which it then sells to the same blast furnace. If you want a definition of circular economy, Primary Energy and Coke Energy in particular does that. It's a very simplified way of describing it, but I think it's absolutely fantastic, and it's critical to the profitability of that blast furnace. And that blast furnace has been deemed essential industry. During COVID, it was operating at peak generation. So we're really pleased with how sort of that investment and its fit within the energy efficiency works. And if I've got time, James, I just want to talk about another one here in the UK, which is EV charging. So we've invested in a developer called EV Networks, EVN, and it's a unique business model, and I'm really pleased that we SEEIT's made this investment. They're rolling out EV charging infrastructure across the UK. The largest one being at the NEC in Birmingham. So that's actually I believe it's the largest EV charging car park in Europe. So how does SEEIT get returns from that investment? SEEIT owns the EV charging infrastructure, and it essentially leases it out to what we call a charge point operator. So this could be, for example, at the NEC, it's BP Pulse. BP Pulse will operate it. They'll manage the usage demand, but will pay a fixed charge to EVN and SEEIT for leasing out the EV charging infrastructure for the next 20 years. So that's really important that I talk about how that structure works, because SEEIT is not taking risk on who uses that EV charger. That's with BP Pulse.
We are providing. Just answer one of the questions that was on here. Actually, that's helpful. Thank you.
Yeah. Sorry, I haven't seen the questions, but I'm glad I managed to answer one of them.
Yeah.
So we're not taking risk on that. SEEIT doesn't. Of course, it doesn't take what I call merchant risk, significant demand risk, and so it's regular contracted income over the next 20 years, which is inflation linked, and that's exactly what SEEIT wants to invest in. And the more we roll out this EV charging infrastructure, the more cash flow it generates. But we also have an interest in the developer itself, and that creates value for the developer and therefore for SEEIT.
Okay, thank you. And that sort of construction element, I mean, I know that's useful because it provides the kind of some NAV uplifts. It's also helping to grow the revenue base. What's the sort of time frame around how long will that 11% be under construction for?
Yeah, it's a great question and quite critical. So we target investments within that sort of 11.73%, that it will go from construction to operations typically within 12 months. And the reason being, we don't want anything in there that's going to be for 5 years and not generating any income. The majority of that construction and development sits within Onyx, so it's solar projects, so relatively low risk construction, or with EVN, so deploying EV charging infrastructure. Again, relatively low risk, can be done much quicker than 12 months if needed. And so that's been key to SEEIT's sort of philosophy or strategy around construction and development, that they need to really, we don't take complex construction risk, and we typically want them to hit operations within 12 months.
Okay, thank you. Now, I'm not expecting you to say precisely what asset you're going to sell, but can you give us a sort of an idea of what the scale is of what you're thinking about doing with the disposals to reduce?
Yeah. So whilst we are targeting and looking at disposals, all of it's within the context of portfolio construction. I mentioned that phrase quite a few times. It needs to benefit SEEIT shareholders, not just for immediate short-term capital, but over the long term for portfolio construction. There are certain investments which are what I'd call business as usual, a bit more steady state, versus some of the more dynamic ones, which therefore make them more marketable to sell. We are typically looking across these. We won't necessarily look at 100% sale. It may make sense to look at 50%, particularly if there's growth that SEEIT has built and would want to crystallize over the next 12, 18 months. And we'd look at 50 to 100% typically for each investment. So the larger ones that you're looking at, 50 to 100 million, for example. But that's probably as much detail as we've provided at this stage, given that it's quite commercially sensitive area to disclose information. Yeah,
that's fair enough. Now, we talked about the opportunity. I mean, 11% yield that's growing is just mad, really.
Yeah.
So given that, I mean, can you give us an indication of how much stock the managers and the directors own, and whether you're buying more, please?
So we have, last year I'll start with the buybacks. We did conduct a buyback program, and we have announced both within the manager and the board, they have been proactively buying shares, not just over the last 12 months, but over the last few years. I don't have the specific numbers with me, James, but again, that's been disclosed to the market.
Okay. Where would we go? Would it be in the annual report or something?
It'd been our annual report, and there have been previously RNSs.
Okay, cool. We'll have a look. Great, thank you. I suppose just to sort of finish up, because we are nearing 12 o'clock. What do you think? We've got elections coming up in the UK and in the US, and we could get change of government in both. What do you think the direction of policy is if we do get change of government? Is it going to make much of a difference?
One thing we've always said about energy efficiency is it's not relying on subsidies. So you don't need a subsidy to change the light bulbs in your building, for example. Where the case for energy efficiency, it's cost reduction and sustainability. And so from that perspective, whether you have a government that's pro-subsidies, one that's against, and we've seen this since SDCL has been looking at energy since 2007, the case for energy efficiency is always strong. It stands on its own merits. You don't need funding from third parties. It's always helpful, but you don't need it to make the case for energy efficiency and deploy that investment. And indeed, energy efficiency hasn't been receiving any subsidies or any material subsidies, and we've deployed and been able to build a significant portfolio on that basis. Lots of people have asked, and we did do an Inflation Reduction Act webinar last year. What happens in the US, because that's a big driver. Well, the Inflation Reduction Act has significant partisan support. It's already being implemented, and particularly in a number of red states as well. So we would anticipate, particularly in terms of where it's marketed in job creation and boosting the economy, and a number of other benefits, that we wouldn't expect it to change in the US. Again, energy efficiency versus other technologies has seen cross-party support across Europe, and we haven't seen that change within different governments. So particularly in the market we operate in, we're very positive. We see far more tailwinds than we do see headwinds.
Great. Thank you very much for that. Quite a comprehensive look at the fund. I hope that was useful for everybody. But thank you for your time this morning, and we'll follow it. And good luck with narrowing the discount.
Thank you, James. Thanks, everyone.
We will be back next week talking to Hydrogen One. I know our sort of popper looks a bit meager here, but actually there's a lot going on in terms of like trying to get people in the right order. So the next week there should be a much longer list here. Anyway, so have a good week, and I'll be back next week talking to 101. Thanks very much.